What if the economy was already in a recession and most people had no idea? Not because the news did not report it, but simply because most people do not know what a recession actually is, what causes it, or how to recognize one when it is happening around them. Today, we are going to fix that. We are going to explain what a recession is, why it happens, what it feels like for ordinary people, and whether the global economy in 2026 is heading toward one. Because understanding what a recession is genuinely useful information for making decisions about your job, your savings, and your financial future. And it is the kind of information that most people only go looking for after the recession has already started, which is precisely the wrong time to be learning about it. Let us start with the definition, because the official definition is simpler than most people expect. A recession is technically defined as 2 consecutive quarters of negative economic growth. A quarter is a 3-month period. Negative economic growth means the economy produced less output than it did the previous quarter. 2 consecutive quarters of that, and the technical definition of a recession is met. This is usually measured using GDP, the total value of all goods and services produced in an economy over a given period. When GDP shrinks for 2 quarters in a row, economists call it a recession. But the technical definition is not the whole story, because recessions feel like something specific in real life, and that feeling does not always wait for the official confirmation. What does a recession actually feel like? It feels like companies freezing hiring. Job postings decline. People looking for work find fewer opportunities than expected. The process of finding a new job, which might have taken weeks in a healthy economy, suddenly takes months. It feels like businesses becoming more cautious. Expansion plans get delayed. Companies focus on preserving cash rather than growing. Meetings about new projects get postponed indefinitely. It feels like consumer confidence dropping. People worried about their financial future spend less on non-essential things. They delay large purchases. They eat out less. They cancel subscriptions. They hold on to their existing cars and appliances rather than replacing them. It feels like credit becoming tighter. Banks become more selective about who they lend to and on what terms. Businesses find it harder to access the financing they need to operate and grow. And it feels like a general sense of economic uncertainty that is very easy to sense in daily life, even if you cannot quite put your finger on exactly what has changed. Now let us talk about what causes recessions. Demand shocks. When consumer spending drops significantly, businesses face falling demand. Revenue drops. Costs remain the same. Companies cut costs, which often means cutting jobs, which reduces household income, which reduces spending further, which deepens the downturn. It is a self-reinforcing cycle that is easy to start and difficult to stop. Supply shocks. When something disrupts the supply of critical inputs, most commonly energy, costs rise across the entire system. Consumers have less purchasing power. Economic activity slows. Credit crunches. When the financial system tightens significantly, businesses and households find it harder and more expensive to borrow. Investment falls. Economic activity contracts. Policy mistakes. Sometimes central banks raise interest rates too aggressively to fight inflation, slow economic activity more than intended, and trigger a contraction that nobody planned for. Most recessions involve a combination of these factors rather than a single clear cause. Now let us talk about 2026, because this is the question on a lot of people's minds right now. The signals are mixed, which is itself meaningful, because in healthy economic periods, the signals tend to be clearer. The International Monetary Fund is projecting global growth of approximately 2.7% for 2026. That is below pre-pandemic averages and below what most economists consider healthy long-term growth. Not negative, so it does not meet the technical definition of a global recession. But weak growth is the environment in which recessions tend to develop. Inflation remains elevated. The Consumer Price Index in the United States rose 3.8% in the 12 months to April 2026, the largest annual increase since 2023. Energy prices drove much of that, with gasoline up over 28% year on year. Food prices and shelter costs also increased above target. Household debt in the United States reached approximately $18.8 trillion in early 2026. Credit card delinquency rates have climbed above pre-pandemic levels, with over 7% of balances delinquent by more than 90 days. These are signs of financial stress that typically precede a reduction in consumer spending, the largest component of economic activity in most developed economies. None of this confirms that a global recession is imminent, but the combination of slowing growth, elevated inflation, rising household financial stress, and geopolitical uncertainty creates conditions that anyone managing their personal finances should be aware of. So what does this mean for you? The people who navigate recessions most successfully tend to be the ones who prepared before they arrived. An emergency fund with several months of expenses. A manageable level of debt, particularly variable rate debt that becomes more expensive when interest rates are high. A clear understanding of your job security and your household budget. And a long-term perspective on investments that prevents short-term market movements from driving short-term decisions. A recession is not the end of the world. Every recession in history has eventually ended. Economies have recovered. Opportunities have emerged from the disruption. The stickman who understood what was happening and what to do about it was always better positioned than the stickman who was simply surprised when it arrived. Quick reminder, everything in this video is for educational purposes only and does not constitute financial advice. See you in the next one.